Okay, so I have a feeling a lot of us are here for this session as well. We all want to take away some insights from this one that we can apply directly tomorrow. But let's see what the panelists have to say about that. First of all, I would like to welcome Mr. Prashant Nair. Prashant is a national news editor at CNBC TV 18. He heads the entire reporting team at the channel. Prashant has been covering and reporting on India's leading companies for nearly the last 15 years. He's also regarded as one of the most astute commentators on financial markets, particularly the stock markets. He has covered global summits like the World Economic Forum in Davos for a number of years. Before joining CNBC TV 18, Prashant was executive editor with NDTV. Now, for our speakers today, we have Mr. Vikas Khemani, who has 27 years of experience, extensive experience in capital markets, and is the founder of Carnelian Asset Management and Advisory. Established in 2019, this boutique investment firm and advisory firm based in India today manages $1.5 billion across various portfolios. Prior to founding Carnelian, Mr. Khemani served as the CEO of Edelweiss Securities for 17 years. During his tenure, he successfully incubated and developed several businesses into market leaders, including institutional equities, investment banking, and equity research. Mr. Khemani is recognized for his strong business acumen and profound understanding of capital markets, earning him a distinguished reputation within the corporate India. In 2014, he was honored with the Young Professional Achievers Award for the service sector by the Institute of Chartered Accountants of India. Next up, we have Mr. Chirag Setalwad with us. Chirag has a vast experience of 25 years in fund management and equity research and another 4 years in investment banking. He started his career in September 1996 with ING Barings, Mumbai as an assistant manager. Thereafter, he joined HDFC Asset Management Company in July 2000. He moved to New Vernon Advisory Services in October 2004 as a vice president. In March 2007, he rejoined HDFC Asset Management as a senior fund manager for equities and was designated head equities in July 2022. He has been managing various equity-oriented schemes. Mr. Setalwad holds a Bachelor of Sciences in Business Administration from the University of North Carolina, Chapel Hill. Next up, we have Mr. Prashant Khemka, who is the founder of White Oak Capital Group, an investment management company serving investors across the world with an AUM of 75,000 crore rupees. Prior to White Oak, Mr. Prashant spent 17 years at Goldman Sachs Asset Management, where he was the CIO and lead portfolio manager for global emerging markets, as well as India equity at the time of his departure. Prashant started his professional investing career in 1998 at State Street Global Advisor in Boston, USA. He joined Goldman Sachs Asset Management in 2000 and rose to be a senior portfolio manager and co-chair of the investment committee of the US Growth Equities team. He returned to Mumbai in 2006 to start the India franchise of Goldman Sachs Asset Management, which he led as the CIO until 2017. He also made the CIO of GEM Equity in June 2013. With top-ranking peer group performance, Prashant won several accolades and awards over the years. Prashant graduated with honors from Mumbai University with a BE in Mechanical Engineering and earned an MBA in Finance from Vanderbilt University, where he received the Matt Wigginton Leadership Award for Outstanding Performance in Finance. Prashant is a fellow member of Ananta Aspan Center, India. He's an avid cricket and chess fan, and he resides in Singapore with his family. It is a pleasure to have all of you with us. Thank you.
Thank you very much for that. Ladies and gentlemen, thank you very much. And it's my pleasure to be able to host this today. And it's a wonderful set of audience. And of course, thank you to the CFA Society India to put this panel together. I think we can safely say that 2026 has started on a pretty brutal note, for the lack of a better way to phrase it. We thought 25 was tough. I mean, I think we're not even 10 days into 2026 and we've been hit from all sides with all kinds of new things. And I was interviewing someone on the air on CNBC, and I asked him a question, and he was an oil analyst, and I asked him a question, and he said, well, I'm not a geopolitical analyst. I said, I think along with oil now, everyone, or whatever you're tracking, you also need to track maybe, a minor in geopolitics, because, we can't ignore it anymore. I saw this, someone I think tweeted it, saying the new definition of EBITDA, the T stands for Trump, right? So I think that's where we are at. So let's just sort of kick this off. We'll, of course, talk about what markets will do in 2026, and we'll ask the three gentlemen here who've got a wealth of experience managing a lot of money about how they would and where they would sort of really place bets and what they'd like to do. Thank you very much, all of you, Chirag, Vikas, and Prashant, for being here. Vikas, let me start with you, right? I mean, I think if I ask anyone in this audience who's the undaunted India bull, always, I think people are going to pick you. How is all of what has happened, right, through 2025 and now 2026 as well, from what we've seen, has that lowered that level of bullishness about India? Let's just start there and then I'll dive in.
So first of all, thank you, CFA Society India, for having us here, having me here. I am told that since morning everybody has spoken negative on India. That's the reason I am asked to open and bring a little bit balance. No, my view on India has been positive, and again, it depends on what time frame, right? I mean, 25, of course, was not a great year from investment outcome perspective. But my view on that is that every couple of years you have similar year, and I would like to take your memory back to 22. 21 was a great year, and we started 22 on a very, very good note, and then suddenly we had Ukraine war, and environment was similar. Uncertainty was there, geopolitical, oil price going up, inflation. Until I think September, it was kind of very, very uncertain. And Ukraine war was still happening, because first reaction of Ukraine was that ek mahine mein khatam ho jayega. And it was never ending, right? But it continued. But towards September, October, I think the environment started settling down. War was still happening, and we had 23 great year. In 2022, small cap index was down about, I think, 10% if I remember correctly, and Nifty was up 3-4%. If you see 25, pretty much similar statistics. Nifty was up about 6-7%, and small cap index is down about 12-13%, right? And a lot of pessimism started with tariff uncertainty, and then now the new geopolitical situation which has come. So I think every year, every 2-3 years, we have similar kind of situation. If I were to look at India economy, right? I mean, in last 12 months, while all these things were happening, we had a great fiscal stimulus by the government, both in income tax as well as the GST cut. We had a great monetary stimulus happening in India, both from, again, liquidity infusion to interest rate cut to growth boosting policies on the credit side. Capex is doing well, government capex is doing well, private capex has picked up. So I think if you see corporate earnings have picked up backed by all these initiatives. So directionally speaking, and in last 12 months, valuations have come down with just sort of passes of time and earning picking up a little bit. And last year India was one of the worst performing market within the emerging market basket, rupee at 90. So this is the confluence of sort of factors you have. You can't of course, you can argue that whether earnings will grow at 14%, 12% or 15%, right? And whether 20p is right or 18p is right or 22p is right. But that can determine only short-term view. But if you look at, so I do believe, from a 2026 perspective, it should be better than 2025, for all the factors I did mention. And still directionally, I am quite optimistic, about India growth story. All our, sort of pillars of growth are in place, our demographic investment cycle, of course, a little bit of this uncertainty around tariffs and export growth and all is there. No doubt about it. You don't like it, but this is the card you are dealt with. And we are going to live, in my opinion, for a long period of time in a heightened geopolitical situation, given the nature of, it's a fight between US and China for supremacy. Now, it's unlikely to settle anytime in a hurry. It started in 22 and is manifesting in different ways, right? So we all have to kind of, in my opinion, get used to living with that kind of uncertainty. And despite all these things, by the way, market volatility has been low. Our implied vols are single digit at the index level. That tells you what? That tells you only the calms, the low volatility in the market. So I feel that 26 should be better than 25 year.
The crazy thing is it is just 1 year, right, into the Trump presidency. There's 3 more to go. And it's kind of scary to think that, we've all seen what's happened in Venezuela. The natural human function is, if something has been successful and it's been so easy, you'd want to try it again, right? I'm not saying something very, very similar, but the man has been testing limits of his power and he's realized that, he's got a lot of it. Chirag, come in there. Broadly, 26 better than 25, as Vikas said, or is there any way to tell?
No, I don't think there is any way to tell, right? We are trying to forecast what the market is going to do any given year. It's a toss of a coin. But I think it's important to keep in mind the journey over the last 5 years and the journey over the last 10 years, right? We're so focused on the fact that we've had a terrible 2025, and sentiment follows the market. Rising market, great sentiment; falling market, terrible sentiment. But last 5-year returns are still in their 20s. Last 10-year returns, for the mid-cap index as an example, is 16, 17%. Small caps is 14, 15%. So we've had a fantastic run for many years. And we've had a 1 year or a 1.5 year consolidation. And in that period of time, we are all scampering and already quite nervous. So I think we have to realize that markets have delivered a fantastic long-term performance, and that's what we are here for. We have no idea. I certainly have zero idea what next year is going to look like. But it seems that we are not out of the woods yet. Right? Valuations are still, Nifty is at a 10% premium, mid-cap is at a 15, 20% premium, the small cap is at a 20, 25% premium. So you need 15, 20% corrections to get you to average. Forget about below average. And the overall environment is, I would say, fairly turbulent, right? Not only geopolitics, which is extremely murky, but even the global growth environment, right? US is growing at 2.5% this year, likely to slow down next year. So I think there is still a lot of question marks, and I don't think the market is factoring in.
Global growth is very, isn't it, as we're kicking off, I was looking at estimates, global growth, US growth, even European growth. Actually, European growth has been next to nothing for 5 years now, but I think it's picked up a little bit, 1% or something in 2025. It's expected to pick up more in 26. So, relatively speaking, global growth is pretty solid. It was expected to take a hit towards the end of 25. It's not. So
25 has been US is, well, there are 3-4 geographies which really matter, right? US matters, China matters, obviously Europe matters. America has surprised everybody this year, but it's unlikely that that's going to continue on an ongoing basis. And they have problems from the labor perspective and from an inflation standpoint. Who's to say? But it's unlikely that that 2.7% growth is going to sustain. China is going through its own set of issues which seem to be a little bit more structural nature in terms of real estate and lack of consumption and deflation and all of that stuff. So it's not like there's going to be a massive pickup there. So US question mark, but you don't want to bet against the US, but US is likely to be muted a little bit compared to last year. China unlikely to recover. And Europe is in the doldrums, right? They're delighted to get 0.5% growth. So, what's going to bail us out? Right? India is not large enough. The 3 large economic blocks are going to struggle. So it's not a fantastic global environment.
But the crazy thing is that the growth, all those numbers, right? You look at India's growth. Compared to our own history, of course, it's lackluster. But compared to global growth, I think we're right up there. And still, the market here has suffered. But that perhaps you can attribute to what we did in prior years, 3-4 years, right?
Yeah.
So maybe a little bit more in terms of time correction, Chirag, this year?
I think it's going to be a toughish year, right? Now, whether we give plus 5, 7, 8, 10% or a little bit minus, but I think as, cliche of consolidation will continue for some time until valuations normalize a little bit more. I think the good news is what? The last 3 panels I've been on, everybody is nervous, right? Retail sentiment has changed dramatically. IPOs have also now slowing down, and the valuations of those are also becoming more sensible. So let us put it this way. A year and a half back, we were extremely nervous. And we were saying this is a market you should stay far away from. We've gone from being extremely nervous to a little bit nervous. Are we excited? No. But the good news is, a year and a half ago, if there was a correction, there's nothing to do about it. Now, when you correct, at least you'll correct to reasonable valuations, and if you continue to correct, you'll correct to cheap valuations. So I think we're in a better environment, but we're not out of the woods yet.
And hopefully earnings pick up as well along the way sometime during the year. Sorry, you want
hopefully.
to add?
I think they will, right? I think the base is a little bit lower. We expect, since I've been in this industry 25 years, we've expected earnings growth of 15 to 17% every single year. Right? And we never hit
at the start.
It's either higher or it's lower. And there's no surprise that the earnings expectation for next year is 15%. But I think the base is lower, so hopefully this time we'll get there.
There's a secret analyst club or something, which is 15%. But Prashant, come in there. You manage money globally. You do manage money globally. And it's all global now in that sense, right? How do you make sense of it? And what is the... forecast is a dirty word at this time of the year. But what do you think? 26 will be better than 25?
See, first of all, thank you, CFS Society, for organizing this and having me here. Secondly, I would say a lot of what Chirag said is the same words that I use, unfortunately. So I don't know what I would add further to what Chirag has said. But it is impossible to predict market. And maybe I can change the words a little bit. I always give this example of the Dawn movie ka dialogue jo hai, that Dawn ko pakadna mushkil hi nahi, namumkin hai. Dawn still gets pakad mein aa jata hai, but to time the market is truly impossible. And to predict, it's like, and I think again Chirag talked about coin flip. Yeah, it is. I say if if I were to flip a coin 10 times and ask you what are the expected heads and tails, you would say 5-5, right? Regardless of what happened in first 10 coin flips, where you'll say 5-5, समझो 8 heads and 2 tails were there. I say, again start with 10 coin flips and I ask you guys, what is it's a fair coin, we all agree. You'll say 5-5 again. भले 8-2 आया, 10-0 आया or whatever, right? So the equivalent of 5-5 in equity markets to me at the start of any given year is 10 to 11%, call it 10 to 12% from the Indian market in rupee terms pre-tax. And today, expectation is no different from 26. And 25 wasn't that bad, as again, I think Chirag noted. If you see Nifty, I think was close to double digits, with dividend was 11%. That's an average year. It's only the small caps that didn't perform well, and small caps, had quadrupled, quintupled, or whatever. So I think if it's a year like 25, I'll be very fine. It was an average year. The average year is pretty good year. Average year in Indian equity markets delivers 10 to 12%. And
Prashant, I'll tell you, the reason why maybe we are feeling particularly slighted and are calling this not a bad year, but is because look at what the rest of the world has done. US is up 22%, Korea is up 70%. Look at what Japan is. Japan, right?
True.
And others. I mean, I'm not even naming some of the
that
others.
is very true. That's a very fair
And it's not
point.
as all these markets have done poorly. They're coming off a very bad 2024, right?
Yes. No, so we manage emerging market fund, as you know. We also have an emerging market ex-India fund. So emerging market ex-India is up 40% in dollar terms last year. And India was down slightly. So that hurts, no doubt. But again, the prior 4 years, India was on a rampage. Collectively, EMX India as a basket did very poorly in the prior 4 years. So these, few years here and there, sometimes someone runs ahead faster. At other times, other markets would run ahead. It's impossible. What's important to know, it's impossible to predict what would happen over the next 12, 24 months. And that doesn't change at the start of any year. I would say obviously safe to say, given that is the case, that this year the disparity we expect not to be as wide as in 25, but that would be the case in any given year we would expect. If you look at valuations of India, so Indian investors look at valuation a little bit differently. The questions on valuation are a little bit differently posed than what global investors would pose. So India may obviously we look at historical, what is the valuation been and what it is right now compared to historical levels. So if you see last 11 years since, let's call it Modi ji's era, the average multiple on forward 12 months has been about 20 times, 21 times. Right now, if you see, it's bang in line, 20.5 times or something, plus minus, negligible amount. If you look at global compare, so the other way to look at it is cross-sectionally. Across markets, how is India's valuation comparing? India has always traded at a higher multiple. I don't mean to say, so that's a wrong notion amongst global investors that India is a higher multiple, so it's expensive. It is not. There are many, certain sectors trade at a higher multiple than other sectors because inherently they deserve a higher multiple. So India inherently deserves a higher multiple because of, in few words, because it's a democracy and the protection of property rights are much stronger in India than in a typical or average emerging market country. So you can't just compare, India is at 20 multiple, rest of emerging markets is at 11 multiple. So India is just twice the multiple. That doesn't, it's completely nonsensical. What is India's relative premium to emerging markets historically, you can still see.
And there you're saying we're bang in the middle of the thing,
so
right?
now we are still somewhat higher than historical average, but see, you average historical always isn't necessarily a good benchmark because events like what happened in China with Xi Jinping becoming a third-time president structurally derated China. And China being 40% of EM market, you can't take that event and compare now. So India doesn't look overvalued. So I think of comparing with US as the most appropriate. It's democracy, faster growth, all those things, ROEs, profitability, centricity, and all that is there. So India today is at a higher discount to US than it has been over the last 25 years. Leave aside two instances, which is maybe three. Two, I would say global financial crisis and COVID crisis. And then now today, it is maybe because of the tariff crisis, you can argue, is the third. But it's only, those two instances were worse than today in terms of relative to US. So I don't think India
This is a strong pitch for foreign money coming into India. But no, Prashant, will happen?
Well, we will see. I think for EM, because 75% of money flowing into India comes as part of EM money, EM allocation. Only 25%, as because you would know, being from your sell side days, 25% comes from India dedicated funds. EM had underperformed developed world for 10 years more, 10, 12 years. So people had tuned off. Many people had completely checked out EM. Now last year, because EM substantially outperformed developed world, you are seeing that interest build up. If that continues, people would have a FOMO factor or left out factor, and they would start, we are already seeing greater allocation to EM that would flow to India as well.
Fair enough. Let's hope so. Let's now, let me ask you this, and then we'll move on to what you like, etc. in a bit. Is there any, and I'm putting it bluntly maybe, all this geopolitics and all of that, right? I mean, from when you invest, and most of the audience here is concerned with not global investing, I'm assuming, but investing in India. Is there something which is like a tangible takeaway? I think we had an earlier speaker on the dais before our session. He said, well, all of what is happening now will show up in the next 3, 4, 5 years in different ways, right? It'll manifest and show up. But for a India dedicated investor, are there other implications? And if so, in what way? I don't know who wants to go first. Vikas?
Implication for India from
everything which is happening, right? I mean, we hear about all this big talk about 40, 50 years of international rules being thrown out of the window, and it's a new way of doing things, and it's all unprecedented. Actually, it is unprecedented. So, yeah.
No, it is. I think, see, whatever is happening in the world is unprecedented, like you rightly said. And we have a new order in the sense, our order is being challenged, order is being questioned, and the fight is happening between US and China. And that's been in works for some time, right? Trump is just one more catalyst in that. So obviously you will have that. World WTO is being challenged, every country is signing FTAs, and also in that sense, the calm environment you have had will probably not remain.
So does that call for lower multiples across for a risk asset like equity?
I mean, that's a very different situation also. I mean, one can argue both ways. If you see, despite all this global, I have never seen India that kind of stable, solid macros, right, as in the past, right? So if you were to look at only from Indian perspective, right, historically, structurally in India, very big risks have come only from 4 or 5 factors. And those structural repairs are all in place, whether it is current account deficit, fiscal deficit, banking system, inflation, debt to GDP, corporate debt to GDP.
Tough to argue for a lower...
So tough. And plus, India's interest rate or interest cost has been lowest ever. Difference between 10-year US and 10-year India. So our cost of capital globally has kind of become competitive as compared to historical times. So if your interest rate goes down, if you put in DCF, your valuation anyway should look at uptick, right? If everything else remaining same, 2% discounting, I don't need to tell this audience, pushes equity valuation by 35-40% depending on what growth numbers are. So there is a case for India's re-rating also, right? So in that context, there will be some interplay, right? I don't know how it will settle. So you will have to deal with the... one interesting thing is for sure that in India, which I have been feeling for some time, when you have a 60, 70, 80 P, that point in time, why do you think today a lot of Indian companies are raising only equity and not debt? Because today cost of equity is cheaper than debt. And that's the reason no promoter wants to do capex using debt, but more towards equity, right? So and that's the reason this kind of correction which we have seen in the last 18 months is very, very important. If you are able to raise capital at 60, 70, 80, 100 P, it is basically cheaper than debt. So I think, I am no expert to see what will the broader trend, but we are going to live in uncertain times for sure.
Chirag, you've had time to think?
No, I mean, clearly things that happen outside of India will have a dramatic impact on us, right? I think we think that we are an India-only economy and it's the India growth story and so on and so forth. But risk appetite is global, money is global. The US is, if I'm not mistaken, 60% of global market cap. As Prashant mentioned, China is 40% of emerging market allocation. So what happens outside of India is incredibly important. And if those markets sneeze and if that economy sneezes, we will certainly get the flu as well. So we are not going to be isolated. So correlation in the long term can be low or lower, but in the short term, correlation is high. And what happens outside of India will be incredibly important. And it is certainly things to be nervous about, right? When you go into Venezuela one day and maybe Greenland the other day, and you've got another 3 years, and there's going to be a lot of news flow in those 3 years. And in the last 3 years, or towards the end of any president's term, things tend to get a lot more volatile. So imagine Trump in a corner, right? When he's not in a corner, he's swinging as hard as he can. Imagine when he's in that corner, how hard he's going to swing. So it's going to be a lot of news flow, it's going to be a lot of volatility, and most people see that as a bad thing. We see that as a fantastic thing. We want markets to be volatile. We want markets to correct every once in a while. We want to create wealth, and the only way to create wealth in a significant fashion is to have volatile markets. You want another crisis. We'd love to have another crisis, right? Because those who invested in COVID, those who invested in the financial crisis, everything, all that money did extremely well. But I think the other thing to keep in mind is this too will pass. When we were going through COVID, we thought the world was coming to an end. Genuinely, it was actually unprecedented. When we had the financial crisis, we could not look beyond it. When we had the European crisis, we could not look beyond it. We've forgotten all of those. COVID was only 2 years ago. We will forget this. And there'll be a new set of issues. And hopefully, these set of issues will create an opportunity, and we'll take advantage of it. So I think the key is you got to be long-term, and you got to have that character and that patience to invest. And if you do, you'll do fine.
That point about, you said you'd love a correction or a crisis, etc. You think we will get one in the next 2 years? Some serious people think we will in a large correction.
Will it happen in the next 2-3 years?
And I'm not talking about India. I'm talking about globally, like an event.
I wouldn't be sitting here if I knew that answer, right? I wouldn't be working for HDFC. It'd be a multi-billionaire and trillionaire if I knew an answer to that question. But let's put it this way: crises today are no longer once in several decades, right? We live in more interconnected times. We live in more volatile times. So in my career of 25 years, we've at least had 3 or 4 massive crises. I think that is really unusual, and that will persist going forward. In the earlier generation, you saw one every 20 years. Now you see it once every 10 years. But is that bad news? No, that's fantastic news, right? You want crisis to events to take place so that we can hopefully take advantage of it.
But you also need to be prepared to take advantage advantage of that crisis, right? So
yeah.
At HDFC, how would you do it?
We are relative investors, right? We are not here to take advantage of crisis in that sense. We are trying to outperform the market. Market down 20%, we're down 15%, we've done a great job, and vice versa. But it's the investor who has to keep that ammunition. We are not going to keep cash. It's not our job to keep cash. That's our perception of it.
Yeah.
But investors have to have some amount of ammunition, dry powder, lying around for them to take advantage of it. If you don't, then you just got to hold on and wait.
Prashant, the point that Chirag made, right, which is all these crises in the past, and we can't look forward, right? Obviously, it's just the way it is. But is there a going back from where we are and the way things are done and the global order, etc.? You think this is permanent? Even if the midterms in November, if President Trump were to, his position is weakened, or whatever. This is his last term, 3 years more. But after him, you think there's a going back to how things were before he came?
Yeah, I think so. See, a new ideology has certainly now firmly rooted, which is Trump-like ideology. So the political, political class of US has realized that you can win elections on this ideology. So someone or the other would always be there to occupy that spot, extreme spot, with the expectation that Trump has won, apna time bhi aayega. However, the voter would not, after this experience, necessarily vote the next time for the same fellow or same type of fellow, because udhar you have to change. The vote might swing the other side, but then if that side goes to an extreme, the vote might swing back again. So a new ideology has taken roots, I think, in America. So you can't rule out that a Trump-like situation won't, or let's say the probability of a Trump-like, you could have never ruled out, but the probability of a Trump-like president again in the coming decades is a lot higher today than it was pre-Trump. Pre-Trump, one would have thought it's too far-fetched an idea to have someone so crazy in some ways to do some, or say, at least. He does less crazy things, but says a lot more. right? Though nowadays it's hard to distinguish. So that is a new feature.
So it's a new feature. It's here to sit, irrespective of the leader. Just to complete that loop, the question I asked both Vikas and Chirag, any implications?
See, implications, my view has always been, and to some degree, again, Chirag covered it, everything that has happened till date in the real world and all their implications in the future. So like Trump has happened in the real world, implication is he may come again sometime. All those are very fairly reflected in equity markets everywhere at this time. So there's no money to be made from these macro developments that everyone already knows and their implications. We can understand and try to understand and debate and what is the market pricing in and risk manage to that and all, but there's no way of generating money from that. By the way, talked about crises, you know. Yes, there are several people, global gurus, who predict crisis.
Yeah.
And they would be eventually right. Every dozen years they would be right, like a broken clock is right every 12 hours.
Yeah.
Doesn't mean they know any better.
But the same thing can be said about optimists also.
Yeah. Right? Same thing can be said about
on the other side.
Both sides.
But let me finish that point, Prashant. The point is any changes to investing frameworks? All these changes. And you said, well, some of these ideologies are here to stay. So any changes of what we've seen on how you'd invest?
See,
or return expectations or P multiples generally? Yeah.
Not really. Nothing that has been, because they've always been, we always feel today is the most uncertain times that we are living in. If you put back yourself 10 years ago, 20 years ago, 30 years ago, you always believed that you are the most uncertain times that you are living in. So it's got something to do with just the recency
You're in a
bias.
philosophical mood today.
Huh?
You're in a philosophical mood today.
That is how we believe, and it doesn't change the fundamental way you do stock picking. To us, money is made in stock picking.
Yeah.
All macro stuff is risk management. You can't make money.
Yeah. So let me ask you that. I mean, in terms of risk management, any implications on that?
See, when things become too volatile, and that, see, as I think Vikas was talking about volatility index and all. Now, volatility index in India is somewhat lower, but many volatility indices around the world are spiking. When volatility spikes, that means the value at risk increases, right? If commodity volatility is very low, and if you aren't invested in metals, let's say, so there's a certain amount of limited hit that your portfolio performance could take. And I agree with Chirag, we're all relative performance. As I often say, there's no such thing as absolute return. It's all relative.
Except
return.
Vikas. Vikas is the absolute return guy.
Oh, he says absolute return. He doesn't know his relative return.
He's not a
Next train ride together, I'll convince him of that. But see, relative. But if commodities are very highly volatile, then volatility, the value at risk is higher. And in that case, we have to manage that risk and maybe hedge that risk.
Because you've been waiting.
Just come in, see, nobody knows whether global crisis will happen, not happen when. That's, in my opinion, the only thing I feel one should understand is how India is placed vis-a-vis some of the historical global crises. Like, let's say 2008 crisis happened, right? It was a mortgage-led crisis. India did not have mortgage crisis. Then why did India suffer, right? So if you just analyze that situation, see, very simple reason why did India suffer that point in time of that global crisis, and what is the situation today? That point in time, if you remember, most of the Indian companies had global borrowings. All the Indian, or many large Indian companies had done global acquisition using global leverage. Hindalco had done Novelis, Tata had done JLR, Bharti did MTN. So each company had global borrowing, global balance sheets, global businesses, right? As the funding disappeared from there or became expensive, crisis happened, suddenly local companies of many, local balance sheet of many companies, they started looking bankrupt. Hindalco was looking bankrupt, Bharti was looking bankrupt, all of them, right? So that came home. Secondly, banking system. ICICI Bank had 30% balance sheet global. If your 30% balance sheet comes under stress, I don't need to tell you what happens to your balance sheet, right? So suddenly large part of Indian corporates started appearing because they were very, very high economic linkages, financial dependency in the global market. Fast forward today, you see no large acquisition by any Indian companies. Indian balance sheets are not leveraged. We don't have borrowings. We don't have ECBs. Those days we had a huge amount of ECBs and FCCBs, right? So anything happening there. So this time around, if let us say there's a financial crisis anywhere in the world, including US, I do believe that this, because of the low financial linkages, there could be emotional impact, short-term sentimental impact, but because of this lower economic linkages, lower financial system dependence, our sort of we might take a knock sentimental, but it'll come back fast. The economic impact will be far lower than what we have had historically, because we have a solid macros and we have a low dependency, unlike in the like in the past.
I think that's well put. Let me ask all three of you a question which none of you want to answer. US-India trade deal in 3 months, in 6 months, or it'll take longer than 6 months? Multiple choice question. Chirag?
I'm looking for that coin to flip.
Oh, I mean, you take a... Yeah, I don't have a coin, but give us an answer.
You know, it's amazing. As fund managers, we are supposed to be expert on companies.
But I can ask you what companies, but you won't... You won't.
No, but let me...
Regulations don't allow to speak about company.
No, but the interesting thing is we're meant to be experts on companies. We're meant to be experts on, obviously, sectors. We're meant to be experts on the Indian economy. You asked us about the global economy. We're meant to be an expert on the global economy. We get to ask our views on gold, silver, and commodities. So we're meant to be experts on gold. So we must be fairly genius, right? And now we are meant to give a view on tariffs.
And I've got three of you, so...
Trump's decision.
Right? Can you imagine? I've not met a government official in the last 1 year. I've not met a US government official in my life. Yet I'm supposed to give an opinion on all the above and say it with a great deal of...
What is your... I mean, look, at the end of the day, as he said, I think Prashant said that... I think you said everything is in the price right now, right? But that's like calling it an efficient market. But it's not... It's
Probability of everything is in the price.
Probability of everything is the price. So you go first, Prashant. What is your sense?
No, certainly. So I think I was hopeful till a couple of months ago, based on all the comments and these things. You know, you like everyone else, you read the tweets from leaders of both countries. It seemed like by March end it should come. But then the most recent comments you hear, you know, if it comes during Trump's tenure, that will be good.
Oh dear.
Yeah.
Oh dear. That is... You're serious? Not...
Well, I think it just most recently, but you never know. Maybe these are both negotiating tactics when you are coming closer to the signing of the deal. At this point in time, from whatever little I know, I'd be happy if it is in this calendar year. It seems less and less likely.
Less likely in this calendar year?
Yeah, just the happening of the deal seems less and less likely.
So I'll just add just one or two things to think about, right? The first is, it seems from initial suggestions that Supreme Court is extremely apprehensive about overreach, right? And most likely these tariffs will get knocked off. The question is, what does it get replaced with, right? And there'll be all kinds of possibilities. So, you know, I think we have to look beyond this, right? And, you know, has the market really, so the interesting thing is people assume that if tariffs come in at a reasonable level, we should rally, market should rally. Did the market really come off when tariffs came in, right? Certain sectors did, right? So you saw obviously a correction, textiles, et cetera, et cetera. But it's not that the market has seen a massive correction because of tariffs. So if the tariff even were to settle at a reasonable rate, is that a reason to believe that the market should rally in a significant fashion? The market is incredibly complex. It depends on how GDP growth, it depends on earnings growth, it depends on risk appetite and liquidity, and there's regulation and so many factors at play that this is one amongst many. Right? So I think you got to forget about all of this. You just have to invest systematically, invest with a 10, 15-year horizon, and every once in a while when there's a crisis, take advantage of it, and none of this will matter.
Chirag, what will we be without our passionately held beliefs, opinions, crazy theories, and, you know, I mean, it's all part of the market, right? I think all of you would agree.
Part of media discussion.
Chirag, let me ask you this. I don't think the issue of Prashant and Vikas Vein, the issue of this trade deal or whatever, it's not about that 17% or 25%. It's also like a bit of a break, right, between India and the US, and particularly at a time when there are all these, I mean, I think you would agree that we're in a place of absolutely radical innovation around the world and sectors across, right? Healthcare and, I mean, AI, of course, and so many other areas. And you need technology collaboration. We like it or not, I mean, the US is essentially the leader in many of these areas. So it's not just about that rate, whether it's 17 or 25 or 50. I mean, I think there are deeper issues why this needs to get done. Would you agree?
So I completely agree. This is not about tariffs, but I think the bigger trend is for countries to now look out for themselves, right? America looks out for itself, Europe looks out for itself, emerging markets will, and parts of them will club together. But I think that global sort of order has changed dramatically. We are no longer in globalization, right? And it got sparked a little bit by COVID, before that by China, and so on and so forth. So it's not that if tariffs go, everybody's going to hug each other the next day, right? It's going to be that everybody's set off on their own path.
Yeah, I mean, in a sly way, there was this thing towards the end of last year. India is an anti-AI trade. Did you guys catch on it? I mean, we don't want to be in a situation where India is called the anti-Trump trade. I mean, I don't think that's in jest, but mostly. Because you want to just come in on this point of, he says not in 12 months, not this calendar year. Unlikely this calendar year.
I mean, honestly, no idea, but I agree with Chirag that US exports is less than 2% of GDP. India grows that much in a quarter. So what I'm saying is it's important. No doubt you don't want a bad situation. US is a growth market. You want to be having this thing, but this is what it is. So, if it happens, I don't know. I mean, we all want it to happen faster, but how do you know? So no idea.
I think the only guarantee I can give, guarantee is a terrible word to use, but I think the only thing which is fairly certain, we will not be talking about tariffs 2 years later. Right? We'll have a brand new concern which will be obsessing us.
We didn't talk about tariffs for the last 8 months, Chirag.
Right.
It just came back into view now because of right?
And we will forget about it. And there'll be a brand new thing on the horizon which is scaring the pants off us.
Yeah.
But it won't be tariffs.
Prashant, you were listening observantly.
I want to
you want to close the loop,
clarify.
yeah.
I want to clarify what I said, or hedge, you can say, because I'm sure when the tariff deal is announced, you're going to ask me on TV. You wouldn't believe tariff was to be announced. Yeah. So I said less and less likely. So it's all the probability is declining with each passing day. I still hope something is announced, because some of the sectors like textiles and all are really under pressure. But from an equity market perspective, it's much smaller, to much smaller degree. And the way I think about it is, hopefully it would work out that way, but, it's more hope at this time. It's a fantastic opportunity for the government to think really, in a outside the box way, if you will, and budget always presents that opportunity.
So what would you like to see? Point it. What would you like to see in the budget?
See, no specific thing, I would say. It's just the mindset. I think we still, I think a lot of things, I think as an Indian, we lack in confidence. And we are very protective in a lot of ways. I think that hurts over time, industry. Just let me take one very simple example. Yeah, very simple. That was 1760 in India. We have this saying 1760 aise issues hai. But in India, it's not allowed for a foreigner to buy a flat. In where I live, where you live, a foreigner cannot buy a flat. Now, what is the logic behind not allowing a foreigner to buy a flat? People would get very emotional. Oh, Firangi, fir se desh pe kabja kar lega. Why should we allow this? You think about it, company, you come to Singapore or wherever, Dubai or wherever you go, those company governments are advertising that you buy property here, we'll give you this, we'll give you that, we'll give you, visa jaldi de dege and all that. When a person is buying a flat, what are they buying? They're buying air. They're buying air that is packaged in concrete and cement and steel. All that put together would cost 1 lakh rupees. That 1 lakh rupees in Bombay, they'll pay tens of crores to buy. And this is something they can't even take away with them. वो इधर का इधर ही पड़ा है. But still that mindset is still कि अंग्रेज आए थे कब्जा कर लिया था. अब वो फ्लैट खरीद लेगा तो इंडिया पे कब्जा हो जाएगा. So that is investment that we are shooing away. I'm giving most basic of an example, but there are innumerable such examples where life is, unnecessarily made difficult. And there are too many areas where we say, no, you can't do this, you can't do this, you can't do this. Rather than having an approach of, yes, you can. Yes, why not? You can. Which is what an enabling business environment is.
An entrepreneur friend who's running a successful business, he told me once in another angle, he said, well, we should have, everything is allowed, and then have a negative list. I mean, that's it. This is what you can't do, but everything else,
True. And so it's got to be, rather than having all these you can't do, everything you can't do, and okay, you are allowed here, you are allowed here. start with, okay, everything is loud. Why should something be on a negative list?
Yeah, yeah. So bolder, basically think bolder in terms of this. Let me just close the loop on the budget. Because any specifics out of the budget, in your opinion, which the government should do, which you feel passionately about?
I think incrementally budget has become an irrelevant exercise if you see last 10 years. Because policy, earlier it used to be a policy statement, no more the policy statement, except I think we see fiscal deficit, direct tax announcements, and some bit of a divestment figure. And
No, some reorientation. 2 years back, we saw the reorientation away from capex into away from capex into consumption.
In my opinion, it's all continuation of the same policy. I don't think this government has ever shied away from capex. They have always boosted capex through different means. So I think I don't see anything different other than continuation of the same. There could be, even if there are some bold statements, it will take time for them to realize on the ground, right? Every year we see some great statement, this institution, that institution. But by the time it comes to the slide, I don't see budget being a specific trigger to kind of markets, in my opinion.
Okay. Chirag, I suspect you share similar sentiments.
I do. I think the budget, as you said, has lost relevance. But I'm sure post, I see the views post every single budget. Every budget has been a 8.5 to 9 on 10. Every budget has been growth oriented. Every budget has been sort of fiscally prudent. I think we got to go beyond it, right? We have 365 days for the government to introduce reforms and measures. Why are we focused on that single day? I think the key question, though, in more seriousness, is how they view fiscal prudence, because this year your tax collections have been far below target and your expenditure still has to be cut fairly substantially in the next 4 months to meet your expenditure targets. So chances are you'll exceed your expenditure targets and you'll underplay your revenue targets. So the question is, will this government stick with its discipline on the fiscal side or not? And I think there are a lot of people, and I suspect I could be one of them, is maybe we shouldn't, right? We don't have to have this holy grail of fiscal discipline. If we are in an environment of uncertainty, maybe you loosen it up a little bit. Other economies have done that, so why can't we?
But so far they've kind of maintained that they will stick with the number, which means they'll have to shore up revenue elsewhere. It's possible, right? What we saw with tobacco recently. I mean, maybe other sin goods, oil.
There's no magic wand, right? I mean, disinvestment is certainly not a magic wand.
Yeah.
So I don't know where that comes from.
Okay, let's just ask each of you areas, pockets where you think things are becoming attractive, are attractive now. Vikas, you go first. You've been in big areas you think are attractive, pockets in the market where you think, on an absolute basis, one will make money this year. Vikas.
I think, again, you have to look at areas where there could be good earnings growth. So I do believe that BFSI as a segment, still we have good legs.
BFSI.
Yeah, as a segment, and especially within that, I guess NBFCs and PSU banks have a good legs to go from this year perspective. I think second, we can see consumer-related play, especially consumer discretionary, can play out really well in this year. Third, which could be surprising, in my opinion, or dark horse would be IT, where I guess you had good order book accretion and execution was getting delayed. That can play out, and with the currency support, I think this year you could see a better earning growth than in the past. So these are the 2-3 sectors I think could probably be winners this year.
BFSI, consumer durables, and IT. Okay, Prashant.
So generally speaking, as you know, we don't have like top-down views on which sector would outperform or anything, but there are certain sectors where we structurally find more bottom-up, opportunities. These are sectors where you have a lot of small caps and mid caps and heterogeneous business models. So you can apply bottom-up, approach and come up with ideas which can substantially outperform the rest of their peers. So from that perspective, what Vikas mentioned, we do find in these sectors consumption, technology, in both these more on the mid and small cap side. Though in BFSI, there is a strong advantage that the larger lending institutions have from a cost of funds perspective. So we tend to have more exposure there. And then healthcare also is where we tend to find a lot of stock-specific opportunities. These four broadly, I would say.
Healthcare, when you mean hospitals?
Including pharma, and I'm broadly including like chemicals as well. And healthcare mein pharmaceuticals, diagnostics, hospitals, CDMO, CRO, all those things, the whole pack.
And IT, mid-tier IT, right?
Yeah, mid-tier, strong execution, mid-tier, so, mid-sized IT companies.
Chirag?
I think they've both covered it extremely well. We are very stock specific. So it's worth pointing out that in every sector that we don't like, there are companies that we like, and vice versa. So we have to drill down to a company-specific basis, things which we can't talk about in a public forum. But I think generally the comments made are very accurate in terms of where the hunting is a little bit easier.
I think we have questions from the audience. Okay, so let's take some of these. The first one is the Indian investment fraternity is steadily warming up to alternative assets, commodities, cryptocurrencies, silver. In an era of uncertainty, is there a thumb rule of investment allocation that is sustainable?
Well, I'm not sure if I follow the question exactly, but I certainly think that alternatives have an important place in your portfolio, right? That's what diversification is, right? Diversification is not having 8 different mutual funds who all operate in a very similar fashion in some cases. So having exposure to alternatives and commodities and global markets and so on, that's true diversification. So yes, it should happen, but I think people need to go in with their eyes open, realizing the risks of other asset classes. But certainly it has a merit and a place in your portfolio, of course.
There is one question, it says, what in your view can cause a 40% drop in markets? It's not my question, huh? It's from the audience. From Prashant or Vikas, one of you?
Something that is currently a very low probability event, becomes a high probability event or becomes actually an event. So something nuclear or pandemic, COVID, something like COVID. Today is a 0.01 probability or 1% probability. Last time it happened 100 years ago. So let's say it's a 1% probability event. Market's pricing it at 1% probability. But if it does happen, then it's 100% event. Right? In that case, you'll have 40%. But otherwise, I don't see, so India, Pakistan, some major, or India, China, some major war. All those are, some small, low single-digit probabilities. But if those were to, and that probability is priced in the market, but if those become actual event, then we'll see a sharp reaction in the market. Markets generally go down very sharply when there is a widespread bankruptcy risk. So any global financial crisis, there was widespread bankruptcy risk because once a company is bankrupt, it can never come back, right? At least for the same equity shareholders. Same way, COVID time, widespread bankruptcy risk. If some such event happens, which prompts a very which wasn't the case in my view, at least with tariffs, there's no widespread bankruptcy risk. But if some such event were to take place which causes widespread bankruptcy risk, then markets can have a substantial correction.
Because in general, which sectors or companies do you think are the most overvalued in India right now?
I think, I would say to greater extent corrections have happened, but I think defense, EMS players, anything which is, I am not, wherever there is a, too much future expected packed in and 70, 80p, and also I could see that defense, railways, EMS, these are the segments where, especially, I think we forget in the environment like this that there's a large part of the terminal value which is part of the valuation. And terminal growth can't be very high growth. And hence, wherever you see extraordinary high valuation, one has to be careful. Some of these things are there, but generally it's more, I would say, some of correction has happened, but still at least it has not come in our comfort zone.
Yeah. I would have thought that one, I don't know if anybody wants to take it, we don't have to take it necessarily, but one takeaway from everything which is happening in the world is that defense spending will go up everywhere, in India and everywhere around the world, right?
Has to, and hopefully we'll see that a massive jump in our budget.
In this budget as well.
Yes.
Yeah, but making money through stocks is another matter, because as you said.
Yeah.
I think one global trend is that rearmament of every country will happen. I think, even Trump announced $1.5 trillion budget for US in 27, and with the current implication, everybody will have to spend, right? That will be there. The only question is that today, how do you identify a company and boil down to, just because I get the trend right, does not mean that I'll make money. Education has been a great trend in India. EV has been a great trend in India. How many people have made money in EV? So trend and direction does not make you money. You have to find company and management and then make money.
Yeah, absolutely. Okay, Prashant, this is for you. Most Asian countries have imposed substantial stamp duty taxes on real estate for foreigners. Shouldn't the government make it accessible to the middle class? I'm not sure what the...
Should the government make it accessible to the middle class?
Yeah, that's how it's...
So I don't see. Singapore has announced major stamp duty registration, but I'm not aware of other countries announcing the same. I think generally countries, it's the dumbest investment.
I think it was the question in response to your statement earlier, but yeah, sorry, go on.
Yeah, I think India doesn't allow, obviously, buying of, I mean, some kind of land you can buy with all the restrictions and all that. But yes, Singapore is unique situation, but most countries do invite and encourage buying property in their country, and Singapore does as well. At this time, they're getting away with a higher tax rate, but when they don't, they'll reduce the tax as well.
Okay, last one from the audience. As an investor, what should my current allocation in equity, debt, gold be given geopolitical scenario? Also, any country-specific allocation? And actually, it's a nice one towards the end because we were talking about this outside. Whether, I mean, we've got a young audience, started their career. Should they try to build some expertise and put money to work, not just in the home market in India, but also try and figure out opportunities around the world as someone who's done global investing?
So I've certainly, first of all, I've always been a 100% equity guy. I think the return expectations outweigh the risks. Now, for each individual, that has to be understood separately, and you have to decide on your own. But within equity, you can diversify. As I think Chirag was saying, alternatives. So, private equity is also equity. So if you have the, know-how and all to evaluate, good managers or direct, that's also equity. But certainly equity beyond India is, to me, on the efficient frontier, if you will, much better risk reward than investing in fixed income or debt, which to me is a permanent loss of real wealth over time. So yes, myself have diversified across, though big chunk is in India, but across equities around the world.
Chirag, any thoughts? I mean,
and the only thing I would add to that is that certainly investing in other markets can make sense, but it has to be meaningful. I think those who invest 1%, 2%, 5% outside of India, it doesn't matter. It doesn't move the needle. So if you're going to diversify, then make that diversification sensible, make it sort of relevant to your portfolio. But exactly what Prashant said, the younger you are, you should be 100% equity, right? You want to be high on risk. And as you get older and your liquidity requirements change and your risk appetite changes, that should once again change in the other direction. But if you're long-term in nature, this is a business about being long-term. If you're long-term, if you're patient, you should have as much in equities as you possibly can.
Vikas, your thoughts?
I think you are talking to a panel with 100% equity exposure. So, and I have 100% equity exposure, 100% in India. I do believe that India is one of the, in last 20 years also, India has delivered 17-18% CAGR. When we are at a juncture of inflection point where our GDP is expected to go, why to bother too much with unnecessary diversification? If your horizon is long term, yes, of course, stay invested. And I do believe that over a period of time, India will continue to deliver. Of course, if you have access to some products, you can invest across. But I'm a big believer of what Chirag just said, that आप 5% बाहर कर भी लोगे तो क्या big deal है? कुछ नहीं उखड़ने वाला है उससे, right? So it's better to do what you understand. It's better to do, where you have better control. I mean, Prashant does because he manages money himself globally. But I would say, best to, I have 100% in India in equity.
Well, I think that's an appropriate time to end this discussion. The time's up. Prashant, Vikas, and Chirag, thank you very much for being with us. I think when we started, there was apprehension whether all the panels before us were negative. I hope we managed to uplift spirits a little bit towards the end especially. I hope that was useful. I enjoyed it. Thank you very much for being with us here today. Thank you.
Thank you.